Hey everyone, Larry Berman here. Another crazy and bizarre week in the stock market. Let's dive right into the chart room and see what's going on. On the economic calendar this week on Friday, we've got UNISH came out with inflation expectations, and 5 to 10 year inflation expectation indicator is something that Powell has talked about for a couple of years now as being very, very important to keep long-term inflation expectation anchored. We saw the month number or the 1 year number go up, and so short-term expectations and longer term both go up significantly at the same time. Significant hit again to consumer sentiment numbers overall. When we look at this long-term number, this recent uptick, it's been hovering in the upper twos for better part of 2 years now. We uptick to the highest level that we've seen post-COVID. Last time we saw readings like this, we saw spikes in 2011. We saw spikes in around when oil prices were screaming higher. And prior to that, we haven't seen long-term inflation expectations at 3.2% in about 30 years. So, what's going on here? And can they keep inflation contained, and do they have to raise rates anymore? And so when Powell spoke this week, after last week's press conference where they hit the bottom, every Fed speaker except for a couple in the last few days have talked about higher for longer, the possibility that they may have to do more. The message of higher for longer has not changed. That's been pretty consistent. But the expectation of going to rate cuts, it's very, very surprising that equity markets responded on Friday this way after Powell tried to clamp down. Basically said that financial conditions, well, with rising rates, tightened up significantly, but with rates falling, now they've eased, and so that's gone. There was some good news out of Taiwan Semi, and everybody knows that AI is just, a big focus. So all the semis ripped higher on Friday, and that led tech and big tech. See here on the updated chart of the S&P 500 in the last couple of days, the 30-year bond auction that came in on Thursday was terrible. And that auction, we'll look at the bond chart in a minute, caused stocks to tick down. And then Powell started speaking in here, and the market drifted lower. It was a little bit weaker in the overnight, but bounced in the morning, came back down, not quite unchanged. But this is where some of the semiconductor commentary came out. I'll point to right here at 10 o'clock. This is where the UNISH numbers came out. And while the market came off a little bit, it really couldn't push it to lower lows. And when something bearish happens, the market can't make lower lows, typically it's going to make higher highs. In an auction type market, it just keeps pushing to one extreme to the next to test where the supply is. And so lack of selling, a lot of buying. Not sure how it played out here, but very surprised. We broke out over the important 4,400 technical level. And as we talked about a few weeks ago, we wouldn't be surprised to see it squeeze even higher here, with a lot of people underinvested in equities, given the last few months of risk off markets. So again, this is not the beginning of a new bull market. There's no reason for that. We still have massive bond supply to digest. Here's the picture of the bond market, again, going back to the Fed and the QRA announcement. So we get the QRA announcement, bond yields tick lower, we get the Fed, and basically, risk on route. Post the FOMC on the first day. that's really big story. And so where is key support now on long bonds until we get the next big turn in supply where they need to issue more coupons? It'll be very hard at this point for the long bond to get much above 495, certainly not back above 5%. Um, the rallies that we've seen post FOMC, obviously we got to an extreme here around just under 470, a little bit of a backup, but into the bond supply. And until that bond market, the bond auction fails, this is right here. So if the US long bond now starts getting back below 470, and you got to just wonder what's going on here. But I think the more likely path of interest rates are back towards 490, 495. That should contain the rally here, but I don't know what equity guys are thinking. Anyways, caution still domestic folks. Have a great week, everyone.